Today we're going to talk about mistakes regarding dollar cost averaging, and if you have followed this channel, you do know I'm a big advocate of it. Especially for anyone that's new to investing, dollar cost averaging has a lot of merits. And since I'm in the industry of advising on investments, I have seen the fair share of mistakes regarding this whole strategy, and today you'll be hearing the top 5 that you need to watch out for. And without further ado, let's jump into the first one, which is using dollar cost averaging as a disguise for catching falling knives. Now, when it comes to dollar cost averaging, my usual suggestion is to buy into indexes or funds whereby it's very diversified. But if you insist on buying a particular company, you need to be aware also that at a certain point in time, it may look like you're actually catching a falling knife. Let's look at an example. This chart over here represents Nokia. And as we know, Nokia was once the world's leading phone manufacturer. But as of now, you hardly see anyone using Nokia phones at all. Therefore, share prices peaked in 2000 with the dot-com bubble. And then it floundered for many years. And actually in 2008 or so, it actually increased in terms of share price again. And I'll explain that period of growth to you in a quick while. But after 2008, you can see that Nokia has never recovered. So what is exactly going on in this whole Nokia story? I use Nokia as an example because it's a really classic case of market dominance by a particular company, and then subsequently it became irrelevant. What we can understand from the dividend history is that Nokia was once a very high growth company. Everything in its future looked absolutely rosy. That's why you see that even though share price climbed in 2000, its dividend was still relatively low at that point of time. It was defined as quite possibly a high growth company. And then when its growth potential faded, you realize that its share price came down significantly. And Nokia kind of transited from a high growth company to a high dividend play. And that's why you see over here in 2008, its dividend per share was at a highest level ever, at 80 cents per share. But as we know from history, that was a period where smartphones were slowly entering into the market. BlackBerry was the first one. And then what we can see is that the fundamentals of Nokia continued to deteriorate. Therefore, its dividend for 80 cents could not be sustained for the subsequent years ahead. And right now, it's less than 5 cents even. So how can we avoid such a fate? The first is to always keep track of the company's fundamentals, especially if you're buying into stocks, and if you really prefer to dollar cost average into a particular company. The second or more effective way is, again, to buy diversified, which is to buy into indexes or funds. In that way, you can clearly sidestep the catching the falling knife risk that comes with dollar cost averaging. With that, let's move on to the second mistake of dollar cost averaging, which is actually triggering dollar cost averaging manually. The whole beauty of platforms right now is they can actually systemize or automate certain orders for you in advance. And as always, when you do investments, plan longer term. Look at your budgets, look at what's comfortable, and set a plan, because when you fail to plan, you plan to fail. And that saying holds true in investments, because when you trigger dollar cost averaging manually, you realize that there are emotional factors that come into play. And let me show you a tabulation by Investopedia, which I've used before for a previous video, to explain what can happen. Now, this is an idea that if you have $50 and you buy into S&P 500, what would dollar cost averaging deliver for you? Quite simply, it actually helps you buy more when prices are low and buy less when prices are high. As you can see, this shaded red box over here, when prices are $9.95, you actually buy 5.03 shares. And when prices are high, you actually buy less. These two shaded green boxes over here, when they are at $11 and above, you actually buy less than 5 shares for the same $50. Now, when it comes to manual triggering of dollar cost averaging, if emotions start to come in, these kind of things could happen. What if when prices go up, the investor, instead of putting $50, decides to double it to $100? Do know also when prices go up, typically there are a lot of rosy news, correct? Oh, we are going back to new all-time highs, etc., etc. Economy is doing well. And conversely, when prices come down, the dollar cost averaging is not triggered because the person is fearful already. Quite simply, when prices drop, you see negative news on the headlines. Oh, inflation is going up, unemployment is coming, recession is coming, etc., etc. So using this as an example, if a person simply doubles down on a month that goes up and abstains on a month that comes down, you realize that the average cost increases from $10.48 all the way to $10.60. And while this looks like a small change, do note also that the fluctuation of this whole example is still pretty thin. Later I'll show you real numbers of S&P 500 to really illustrate to you that the key benefit of dollar cost averaging is to remove emotions. When it goes up, don't change. When it comes down, don't change. When you do it manually, these are things that you need to fend off and you make the equation unnecessarily harder. Now before we go to the third, fourth, fifth point, let me share with you, I'll be sharing with you a further tip towards the end of this video. And as always, if you have benefited, smash on like button and smash on the subscribe, especially if you like to learn proper concepts of investments and retirement planning. So without further ado, let me share with you the third mistake that you need to watch out for, which is to buy in at target levels instead of periodically. There are a lot of ways to define how to average in. And dollar cost averaging, when it's systemized, is to buy in consistently at a fixed period of time. But on the other hand, when you buy with a targeted level, you realize that there are certain risks. And let me explain things. Do you realize something about the markets? When it goes up on a bull market, it goes up very slowly, correct? And then when something bad happens, it crashes down and then goes up slowly again. And therefore, there's this saying, when markets go up, they take the stairs. And when markets come down, they take the elevator. Very true, correct? Because at this moment of filming, Nasdaq is entering a bear market and the crash has been very rapid. But the whole climb has been so slow and patient, and many investors' paper gains have been wiped out in this last few months. That is why when you buy at a targeted level, you realize that you buy into a position that's way too big for your comfort. Let's pull up the chart of S&P 500. You realize that if you have decided to buy S&P 500 with $10,000, whenever it goes down by 100 points, you realize that this whole drop in the last few months, you have entered the market 9 times already. And if you are a new investor, suddenly you have a 90,000 investment pot, which may start to look uncomfortable. On the other hand, if you do dollar cost averaging on a fixed period, you build the portfolio size consistently and at a much slower pace. It's a bit like climbing Mount Everest. You know, hikers, they need to go to base camp first, acclimatize, start to get their oxygen level adapted to the new situation, and then progress to a higher place before reaching the summit. Same thing with investments. If you quickly build out your investment size because market crashes and keeps making new lows, you realize that you quickly build a position that you may not be ready for. Take note again, when your investment portfolio is 50,000, a 20% swing would mean 10,000 paper losses. Conversely, when it is 100,000, a 20% swing is $20,000. And when the portfolio is 500,000, a 20% swing is now $100,000. Slow and steady wins the race. The market is always there. Don't rush to build a position too quickly. Give yourself some time to acclimatize, and naturally you handle your emotions better and see good results in your portfolio for the long term. With that, let's move on to the fourth mistake for dollar cost averaging, which is to actually stop it or reduce it during downturns. Now this has a bit of correlation to the second point, which is to do dollar cost averaging manually. But even when you set it to automation, you realize that you still have full liberty as to when to stop or reduce it, correct? And therefore sometimes you have this itchy finger problem. I don't know about you, but I guess it happens to everybody to varying degrees. And as always, if you have a personal story to share, do leave in the comments sections below. There'll be negative thoughts that start to come in when markets turn soft. Hey, why pour good money after bad money? Or why not stop investments? You know, investment climate is no good. Might as well go and buy property instead. There'll be different voices that come to your head whenever markets come down. And when you get emotional, that's where you start to do itchy finger things, such as to tweak with your dollar cost averaging and deviate from your original investment plan. So as always, if you're unsure, look for a professional advisor. And as always, if you're keen to look for my contacts, look for my summary sections below for one-to-one advisory work. And with that, let's move on to the fifth mistake of dollar cost averaging, which is to change it to buying the bottom instead. Now, you know, in a bear market, low gets lower, correct? But there's a surprising thing that you may or may not have realized already, which is this. In a bear market, the converse is also true, which means markets go down using stairs and shoots up using the elevator. And what do I mean by that is that you'll see protracted periods of downturns where it sucks the soul of everybody. But once there's anything positive, you see it spike up very quickly. And it always seems like it's all clear already before it starts to slide down to a new low. And therefore, at every bounce, you realize there's this term dead cat bounce, which suggests that investors start to celebrate prematurely, thinking that markets have reached a bottom. And when you start to look at news at that point of time, you might start to think that that really is the bottom, and why not change it to a buy lump sum? Because if that is the bottom, might as well put as much as you can to ride the potential new bull market up. That is a problem to note, especially if you are new to bear markets. And then I've actually this previous video that suggests that buying the dips is actually a poor strategy as compared to dollar cost averaging. So I'll leave it to the end of this. And since you stayed with me to the end, let me suggest a bonus tip for you, which is after you've done a dollar cost averaging for a substantial period, say for 2 years or 3 years, you realize that your portfolio size is way bigger than the monthly amount you start to put in. That is actually when you need to do effective rebalancing of portfolio. Let me know if you're keen for me to do a topic on rebalancing your portfolio. And as always, let me invite you to some of the previous tutorials I've done. Invest safe, stay optimistic, stick to your investment plan, and I'll see you in the next video. Take care and goodbye.